Good morning and welcome to today's webcast, Manufacturing and Consumer Products M&A Tariff Implications. Before we begin, I'm going to play a brief housekeeping video.
Welcome and thanks for joining us. Our webcasts are designed to help elevate your business performance. Transform your future for the better with advisory solutions tailored to your vision and supported by our collective technical resources. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget. You can ask our presenter questions during the webcast by typing a question in the Q&A window and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. As a reminder, the presentation you're about to see is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
First off, I wanted to acknowledge our big news that Moss Adams and Baker Tilly have joined forces to create a new firm, one designed to serve the needs of the middle market. It's really exciting, and you can read more about it on our website from the link in our console. With that, I'll turn it over to Torre to get us started.
Yeah, thanks, Kiva, and welcome everyone to our webinar on how tariffs are influencing the M&A market, deal valuation, due diligence, and post-deal integration strategies. Obviously, it's a very hot topic, and we have a lot of folks signed up for this webcast, and I'm excited for our discussion today. As mentioned, my name is Torre Hammer. I'm a principal at Baker Tilly, and I run the firm's manufacturing practice. Baker Tilly is the sixth largest accounting firm in the U.S., and we exclusively serve the middle market. We're industry focused, and this webinar is being sponsored by our industrials and consumer products practice. Now I'd like to introduce our speakers. First, we'll hear from Dominic Cellitti. Dominic is a senior manager at Baker Tilly, and he provides financial planning and investment advice to our private client practice. Then we'll hear from Paula Roberts. Paula is the chief investment strategist at KKR. And finally, we'll hear from Brad Porter. Brad is a principal at Baker Tilly who works in the transaction services practice, and he focuses on financial due diligence for the middle market. Now, for the format of today's discussion, we'll hear from each of our speakers, and we'll have some time for audience Q&A towards the end. So if you're listening and you have questions to our speakers, please submit those questions through the Q&A feature, and we'll do our best to get to them. And with that, I'll hand this over to Dominic to give us an overview of the markets.
Yeah, thanks, Torre, and good morning. And undoubtedly the major driver in market volatility in 2025 so far. Even with ongoing and recent geopolitical events, trade policy and its second and third order effects have dominated the headlines. The positioning and mind of investors kind of across the board. Even with all that we've been through, though, major U.S. indices are flat or slightly positive on the year, but certainly not telling the whole story. Markets initially had a weak start to the year in the heels of slowing momentum coming off of trade policy rumors. And then there was some brief relief, but those rumors quickly turned into executive orders. And eventually what we all saw on April 2nd was sky-high tariff announcements by the president. In response to the market, it fell by 19.5%, nearly putting us into bear market territory. But within a month, we retraced that whole 20%. And now in mid-June, we're 23% off the lows. So the common theme here so far this year has been more headline risk really than any fundamental policy changes. The opening tariff salvo appeared to be much more of a negotiating tactic that's been walked back, as we know, and tariffs will likely settle at a much lower rate than where we came out the gate in April. Consensus is around 10% across the board, with exceptions here and there to certain locations and products. Now, recent geopolitical events have reintroduced some volatility, And although there are unfortunate human costs in the conflicts in the Middle East, the U.S.'s fairly independent energy capabilities and less reliance on the Middle East for oil have minimized the potential effects on the market so far. So what has all this uncertainty done for growth? Well, Q1 GDP came in at its first negative reading in 3 years at an annualized rate of negative 0.3%. However, there's a lot of noise in that number, with net exports coming in at negative 4.9% alone. So given the pending tariffs, this number really represents the vast amount of businesses stockpiling inventory prior to those tariffs being implemented. If this component was adjusted as an outlier, we'd likely be looking at a 2% plus GDP reading. So how's the consumer doing? Well, notably the consumer, which is the largest component of that GDP, and in fact, around 2/3 of that number, continues to spend, albeit at a slower pace, but some of that spending data also has some significant noise. March showed a huge pull forward in demand, likely from consumers also trying to get ahead of price increases from potential tariffs. And then this morning, we had a negative 0.9% reading on retail sales on a month-over-month basis. Now, although it's positive on a year-over-year basis, we could be dealing with either slowing consumer or the fact that a lot of those purchases are just simply pulled forward, and a lot of the data is still not too clear. So overall, though, the consumer is still pretty healthy. Balance sheet looks good. Liabilities make up about 20% of the consumer balance sheet, so leverage does not seem to be an issue. But we've seen some recent increases in debt delinquencies across student loans, credit cards, and autos, which has been pretty relegated to the lower end consumer. So although the percentage has begun to increase, the nominal values are not super alarming at this point. One of the biggest macro risks at this point would be potential tariffs impact on inflation. So far, we have not seen this really come to fruition, but we really have not had tariffs in full effect otherwise. And we could be seeing those pre-tariff inventories still being sold off, which we've seen in some current inflation reads being lower than estimates, with the latest read in May being at 2.4%. So whether this holds certainly is a factor of where tariffs land and how businesses decide to approach their pricing. Our take is that we may see more of a one-time price increase and a base adjustment versus a sustained inflationary issue over the long run, but that's yet to be seen with tariff policies still in flux. So moving on to the markets, as I mentioned, major U.S. indices have been pretty resilient so far, given the lack of clarity around any trade policy. Earnings have continued to deliver, even with that uncertainty. And international markets have been, superior in their outperformance this year, with the Eurozone returning north of 20% and China returning north of 15% so far this year. Fair amount of that return, however, has come from multiple expansion in both areas, and currency effects account for a significant portion in the Eurozone. China has had some earnings relief, but this outperformance in both areas has really been driven by assets simply getting too cheap compared to any differential in earnings fundamentals. Yields. So this has been one of the more volatile areas of the year so far. And what I would say is probably the biggest market scare that we saw was in April, with overnight spike in yields. This came from a confluence of risk of decoupling from the U.S. and other economies around the world, with the trade policies, concerns about U.S. growth in general and our ability to repay our debt, and soft demand at Treasury auctions for multiple reasons. So because of this, we saw yields rise rapidly in April, which culminated with Treasury Secretary stepping in and pushing the president for the initial 90-day pause on tariffs that we saw. Also, there's a potential flight to alternatives, which includes also added risk from our ever-growing deficit, as I mentioned, and the potential for some sophisticated hedge fund trades, the carry trade unwinding. So in general, it spooked a fair amount of market participants across the board, and I think that's why we saw the action that the administration take. Yields are now settled with the 10-year Treasury hovering around 4.3 to 4.5%, and hindsight being 2020, we now know they're really wasn't a flight to alternatives by foreign institutions, somewhat on the equity side, but Treasury holdings have essentially moved sideways when we look at inventories. And after all, there's really not a current alternative to U.S. Treasuries, whether that's in regards to volume, backing, or liquidity. Finally, the Fed is currently meeting today and tomorrow with a high likelihood of no rate cut at this meeting. Currently, the Fed funds rate stands at 4.38%, and the market's pricing in 2 cuts throughout the rest of the year so far. But the Fed's really caught in a balancing act at this point between inflation coming down, which calls for cuts, and unemployment rate being pretty stable around 4%, which some take as a reason that they don't need to cut. But we believe their commentary, which will come out tomorrow, will lean more dovish given the current rate is well above target and current inflation is likely to be the biggest factor moving forward, but any kind of certainty in tariffs will certainly help cement that. So as far as investment opportunities that we're currently looking at with the market, traditional and non-traditional infrastructure are big areas that we've leaned into. So we've had over $1 trillion in U.S. government spending earmarked for infrastructure development and improvement projects. So more traditional assets like roads, bridges, and tunnels, imperative to our day-to-day lives. But if we look forward a few decades, there's a runway for tens of trillions of dollars of investment that's going to be needed to sustain just the essential infrastructure we have. Then we have $1 trillion plus earmarked by private businesses and new infrastructure economy. So data center builds, growing demand for compute power, AI, and AI adjacent spending. Commercial real estate's another attractive area right now. With recent repricing over the past 3 years, looking outside of office exposure, lack of housing and multifamily, industrial and warehouse sector with increased supply chain onshoring and e-commerce build out. And then we have a substantial aging population, creating a large demand for healthcare facilities that simply don't exist at this point to the volume that's needed. Cybersecurity would be the final area I'll touch on right now. So obviously a sector that's moved from more of a cyclical, high valuation tech focus to an imperative for most companies at this point. Insurance against cybersecurity attacks typically outweigh the cost of prevention, and getting coverage is almost impossible for these types of events. So definitely an attractive area that's become more of a staple.
Great. Thanks,
Thanks
Dominic.
for that, Dominic.
Go ahead, Paula.
Terrific, Torre. Thanks for that, Dominic. I'm happy to go next and share views from KKR on how we're seeing the market as it is today, which is largely in line with what you described, Dominic. But I'll second contextualize that in describing what I think is going on structurally that's actually creating some of the volatility and uncertainty that we're seeing today. And finally, I'll close on what I think that means for portfolio positioning and how you can create a portfolio that allows you to achieve your goals despite the uncertainty, the shift in returns, and the shifts in correlations. So starting with the economic backdrop today, it's interesting just to think about 6 months ago where the market was versus where we are in June, right? So 6 months ago, everyone was talking about animal spirits that would be released. This was going to be a banner year for stocks. There was going to be a ton of M&A activity. Just 2 months later, everyone was worried about a recession, right? And then gyrations from month to month or week to week ensued thereafter. We agree with what you said, Dominic. We think we have solid growth ahead. We think there are a lot of fundamentals in the U.S. that remain sound, from unemployment rates remaining low, private sector balance sheets remaining healthy. So that's both on the consumer side as well as on the corporate side. We have treasury yields, which have been quite volatile, but are lower today than where they were at the inauguration, and the price of oil is lower. So all of that is actually supportive of growth. Where we have issues is really in the government sector, where the level of leverage is high, and that is part of the reason we're having a bit of this treasury yield volatility, as well as the concern around the deficit. So all that to say, in aggregate, the fundamentals are solid, But there are cracks, if you will. Within the consumer, we agree lower and middle income consumers are pressured. In the corporate sector, we think smaller companies are pressured as well. So be careful of how, in terms of positioning there. But overall, I think being a steady, remaining invested and leaning into steady investment pacing because you can't time the market makes a ton of sense. And one of the, paper I wrote a couple of months ago, the volatility that we're seeing this over the past 6 months has largely been driven by announcements around tariffs. And so we've seen the market do this, whereas fundamentals have remained solid, and the benefit has accrued to patient investors who've really been focused on the fundamentals. So we continue to be in that camp where we expect positive, though low single digit, 1 to 2% GDP growth. We expect the Fed to be able to cut twice this year, especially given the both payroll data as well as the CPI data that we saw today, and then have additional cuts next year. We think the 10-year at 4.3 is close to where its long-term yield will be. So we think it gets back to 4%. So all of that is pretty positive for risk assets, but we are talking about, in general, a slower growth paradigm. Now, what's important about that, that's sort of now where we are. What's important, though, is to contextualize that against the backdrop of what's going on and what has been going on, frankly, not just in the past 6 months or year, but for at least 5 or 10 years. And that is what we term tectonic shifts, which is a fundamental shift in a number of forces in the global economy that is driving an entirely new investment regime and macroeconomic backdrop. Now, what do I mean by that? Well, one, as I walk through the forces that I'll mention, what you'll notice is that each of these forces is creating uncertainty, increasing inflation volatility, and shifting the way stakeholders and regional parties are relating to each other. And that is why the requirement is to think differently about your portfolio going forward. So let me walk you through what I mean by these tectonic shifts. The biggest one is geopolitics and the volatility around geopolitics. If anyone on the line is a student of history and you remember studying Bretton Woods, countries of the West would largely, sit around a table and subordinate individual interests for the benefit of the whole, right? For the benefit of shared interests. You just read the headlines today, that doesn't seem to occur as much. Certainly there are bilateral agreements being discussed as, related to tariffs as an example, but there's a lot more competition going on today, especially around strategic industries, be it data or energy or pharmaceuticals, for example. That is driving nearshoring, onshoring, that's driving domestic manufacturing, and on net, that is driving an increase in inflation volatility. The other factor I point to is the energy transition. So think about Russia's invasion of Ukraine, think about the announcement that we've heard recently, where there are now strategic and potentially physical altercations or war driven by the shortage of these critical minerals that have become in short supply because of these conflicts, right? Now we, have more antagonist relationships with, countries like Greenland or, different countries around the world over some of these critical minerals. Then you have demographics, where for a long time we've been talking about the aging of the population. Added to it are the shifts in immigration with more constraints around labor. So labor supply growth is slowing significantly, which is driving upward pressure on wage costs. And then the final two categories I'll mention are AI and fiscal stimulus. AI should be the panacea, right? AI, the US exceptionalism story recently has largely been driven by a productivity story. It actually has not included AI thus far, but AI is what we are all betting on for the next 5 or 10 years. In the short term, however, in order to scale AI, you need water, you need energy, you need labor. And as I just mentioned, those are in short supply. So AI in and of itself, why over the long term, it should help keep costs in check. In the short term, it's going to be a driver of some of this inflation volatility that I mentioned. And then finally, it's just fiscal stimulus, where in the US, because of DOGE, we're shrinking, whereas in Europe and Asia, they're increasing fiscal stimulus. So think about Germany around infrastructure, or Asia, fiscal and monetary stimulus. That whole picture that I've just painted is driving increased inflation volatility. And why does that all matter? Why did I just spend the last 5 minutes walking through that? Well, those forces, even, after COVID, where we said, oh, we figured out the supply chain issue. Well, then it was the energy issue. Oh, then we figured that out. Oh, well, then it was an immigration issue. These aren't going anywhere, right? They're rearing their head like a game of whack-a-mole, if you will. And that matters because in an area or a paradigm of elevated inflation volatility, that's driving higher rates and also a higher correlation between stocks and bonds. And that's really the punchline. So in 2022, a global stock bond portfolio underperformed by negative 17%, right? That is not how those portfolios were designed to operate. If stocks were down, bonds should have acted as a shock absorber, right? But we've seen correlations remain high, even though inflation, the level of inflation has actually come down. But inflation volatility is still elevated, and we don't see that going anywhere anytime soon. Now, to the third part, what do you do then? In this new world where your grandfather's or even your portfolio that you've had for the past 10 years is unlikely to work over the next 10 years, how should you be positioned? Well, that's where I think, and Dominic, you mentioned, where alternatives provides a great solution. In 2022, when stocks and bonds underperformed down 17% net, global private infrastructure, so not KKR data, the median manager in global private infrastructure was up 7%. In our balance sheet, as we saw this happening over the past 5 or 10 years, we've shifted our positioning to increase allocations to what we call collateral-based cash flows. So these are cash flows that provide steady income, provide downside protection, as a hedge against inflation, as well as some opportunity for alpha, for upside. Now, where do we find that? We find that in infrastructure, like I just mentioned, asset-based finance, real estate credit in particular right now. That's where we've increased our allocation. And then finally, the point I'll make is over the next 5 years, from an equity perspective, the past 5 years have been terrific for public equities, especially US public equities, especially mega tech US public equities, right? But it's very hard to make the math work to expect that the 15% CAGR that we've experienced over the past 5 years could continue over the next, right? Given elevated valuations, even despite the dislocation we've just seen, elevated valuations, shrinking opportunity set, higher inflation, higher rates, very difficult for the S&P to do that over the next 5 years. So we see forward returns on a CAGR basis going from 15% down to 6%. And so private markets are ways to bridge some of that return. In private equity, for example, we see the illiquidity premium increasing. For the median average manager, in general, the excess return is around 400 basis points. We see that over the next 5 years increasing to 600 basis points. So for the reasons I mentioned, either from a collateral-based cash flow perspective or from a return maximization perspective, I think there's a lot of opportunity in private markets to incorporate into a portfolio. Can stop there and turn it back to you, Torre.
Yeah, thanks, Paula. Great info. Now I'll turn it to Brad to give us just some insight into what he's seeing on the financial due diligence side and how tariffs have impacted deals that are in process.
Yeah, good morning, everyone. Brad Porter here, principal with Baker Tilly. I lead up our Texas due diligence quality of earnings group, primarily working with buyers and sellers on middle market M&A transactions. So I'll give you a quick rundown of what I'm seeing in the market from a couple clients' perspectives, a little bit of deal volume and stats, and just some other general thoughts. Tariffs are no longer a background regulatory issue. They now play a central role in M&A strategy, especially in the manufacturing consumer product space. Just a few points here. U.S. middle market PE exits lost a lot of momentum so far in 2025. We saw a little bit of a brief rebound last year, even as the broader PE industry continued to see improvements and realizations. The tariff policies have definitely put an impact on transactional activity we've seen so far in year-to-date 25. The middle market has been hit harder by some of these erratic tariff shifts and what I call policy whiplash this past year. Moreover, companies in this middle market often lack access to the IPO market, giving them fewer exit options than some of their larger cap peers. A amid this renewed sense of uncertainty and whiplash, M&A in Americas as a whole has fallen back in Q1. Deal volume, total deals, was about 2,700 in Q1, which represented let's just call it a 28% year-on-year drop. So this is the lowest transaction tally in the past 3 years. However, it should be noted that values are still running high by historical standards. So what does that mean? It just means that, quality assets will still trade at a premium. And so I think, buyers are a little more hesitant, but still pursuing those quality assets. So, what we're seeing from the work we do is that deals are taking longer in general or stalling out. Sellers are walking away more, waiting for more certainty in the market. Who knows when that certainty is going to be coming? Buyers are not willing to pay a premium with tariff exposure and uncertainty. So while sometimes this is good for a practice like mine, where maybe we're asked to continue to update our work and continue to monitor and track EBITDA performance of the companies, we like deals that close, and our clients like deals that close. So it's become more of a, with the uncertainty from tariffs and investors have become spooked, leading to conservative valuations and longer deal timelines. Currently, I have 3 manufacturing clients who are in the process of going to market that have stalled out or not getting the offers that they were expecting. One even had a record Q1 where EBITDA was greater than all of the prior fiscal year of 24. However, the unpredictability of the impact of tariff policies has caused their bankers to press pause until there's a little more clarity in the market. So that's just the middle market. There's also, and Paula can probably speak to this or sees it on a day-to-day basis at KKR, but PE realizations, which are the gains that the GPs make on their portfolio investments and ultimately pay out to their investors out of the 6 largest publicly traded alternative asset managers, was down a collective 50% from Q4 24 to Q1 25. So it's just showing that these tariff trade wins aren't just hitting the middle market, they're hitting everyone. And so, for investors, there's nothing scarier than selling into uncertainty. So that's kind of where we're at with all this tariff whiplash. So what are some of the effects on M&A activity and valuations? And tariffs hit earnings quality by increasing costs, which squeeze profit margins if the companies absorb them or raise prices and risk losing demand. Higher input costs for imported goods like steel, electronics directly cut into EBITDA, making earnings look less sustainable. Tariffs on key industrial inputs like steel, aluminum, semiconductors, machinery components have driven up production costs, directly affecting EBITDA and reducing valuations. There's a buzzword that's going around. It might sound kind of familiar. It's probably an oldie but goodie, but it's reshoring. It's not just a buzzword anymore. It's kind of a real strategy that companies are looking to go about implementing again. Manufacturers and distributors are bringing operations back onshore to the U.S. instead of subcontracting to their international manufacturing partners for various reasons, to reduce lead times, gain control, but probably most importantly to avoid tariff drama. It's become a full-blown financial strategy. It's also led to some improvements in even getting their products to their clients quicker in some instances. So consumer good companies are highly vulnerable to tariffs on finished goods and raw materials, such as textiles, electronics, food ingredients. Tariffs erode those margins and force price hikes, reducing competitiveness, making targets less attractive unless they have pass-through pricing power to their customers. Those that can pass costs to their consumers without losing market share have a leg up on their competitors and PE buyers. Let's talk about deal structures a little bit. Tariffs are having an impact on how deals are getting structured. Buyers are getting cautious, so they're leaning more on earnouts or contingent payments to hedge tariff risks. For example, a deal might tie 20% of the purchase price to the target hitting EBITDA targets post-close. This protects the buyer if tariff spikes costs or erode margins. Earnouts tied to post-close margin performance are more prevalent when future tariff impact is uncertain, and that's definitely the environment that we're in right now. What's also becoming more prevalent is the use of escrow accounts. They're popping up more and more, with funds set aside to cover potential tariff-related hits. Sellers with diversified sourcing, such as multi-country supplier networks, can command better terms or avoid escrow demands. But sellers are pushing back. They're demanding more higher upfront cash or reps and warranties to limit their exposure to tariff-driven earnings dips. But buyers are being as diligent as ever. Buyers are demanding detailed tariff exposure analysis, which can lead to price adjustments or walkaway clauses if the risks are too high. Buyers often restructure deals as asset purchases to avoid assuming historical custom liabilities or anti-dumping penalties. So definitely deal structures are changing than they have historically. Let's briefly talk about working capital. I think working capital in any transaction is a hot point, and something that has the potential to always go sideways post-close. But tariff fluctuations can really shake up working capital as inventory costs have risen, potentially inflating current assets and hiding cash flow risks. So tariff uncertainty has pushed a lot of companies to overstock inventory as a buffer, further locking up cash flows. Higher tariffs jack up the cost of imported goods, inflating inventory values, which ties up, again, more cash and inventory. So think of a manufacturer holding 20% more costly raw materials from tariff countries like China. This really can stretch the cash conversion cycle as you're sitting on pricier goods longer. A lot of manufacturers have pre-purchased materials in bulk before tariff hikes, inflating inventory values, and it really distorts typical working capital levels and trends. The stockpiling of inventory can lead to excess inventory risks if demand projections do not materialize. Further, capital equipment, CapEx, imports also have spiked pre-tariff, which can create mismatches in net working capital pegs. So the old days of just looking at the last 12 months and calling that kind of your normalized working capital are kind of gone. You have to take a more analytical approach, maybe looking at pre-tariff history, or maybe a longer look of what is normalized. Accounts payable, that can get tricky too. Your suppliers that are facing tariffs might demand faster payment to cover their own cash flows, shrinking your payment terms from maybe 90 to 60 to 30 days, increasing pressure on cash outflows. And on the flip side, if you're passing your tariff costs on to customers via price hikes, accounts receivable might be ballooning if buyers delay payments due to higher prices, especially in competitive markets. Companies may find it difficult to pass tariff-induced price increases to customers immediately. If customers delay payments in response to price hikes or request longer credit terms, this could lead to extended day sales outstanding, further straining what could already be a tough liquidity environment. So needless to say, these fluctuations and tariff whiplash have the potential to lead to tense working capital true-up negotiations post-close. So definitely be thoughtful about what you're doing from a working capital perspective. So, I think we touched on this a little bit. Dominic did, but so what industries are less impacted by tariff policies? So, is it all doom and gloom? No, for sure not. Service sectors, professional services, IT services, consulting. These are industries that rely heavily on labor and intellectual capital rather than on physical goods. As was briefly mentioned at the beginning of this call, Moss Adams and Baker Tilly have just underwent a recent transformational merger of our two firms, again, professional services firms. So we're seeing a run of that. Healthcare services are less impacted. Most of the services are delivered domestically. Minimal reliance on imported equipment or supplies, and while medical devices might face tariffs, they're a small fraction of the cost for service-focused providers in the healthcare services space, and in real estate as well. I think Dominic touched a bit on that as well. Totally agree with that. So, in summary, tariffs have materially impacted our M&A world. Our clients are having to work harder to get their deals closed. They're asking us to do deeper dives and analysis on working capital that maybe we haven't historically had to do. We're glad to do the work for them, but it does make it more challenging. I think what's even more challenging is putting models and projections together. How are you able to predict policy that could change tomorrow, next week, next month, and put that in a reliable model that you can sell to your investors, to your boards, and they have confidence in what the future is going to look like. So I think the key word I come away is uncertainty. It's really driving kind of an up and down market. The middle market, it's a resilient market, so I have faith in it that we'll continue to stay busy. But I think more interesting, we'll just see how the tariff plays out in the geopolitical aspect that's going on right now. But that's kind of a recap on what I'm seeing out there in the market, Torre.
Yeah, thanks, Brad. Really good insight there. That was excellent. We are getting some questions come through the Q&A, and Paula, I'll direct this first one to you. Brad mentioned some of the challenges with valuation and with exits and deal sourcing. Just wonder if you can comment on KKR's approach to deal sourcing and valuation, given the tariffs and the uncertainty around these tariffs.
Happy to, Torre. Maybe I'll answer it in two parts. One is, the way we source deals, which, as you know, extends beyond M&A, extends beyond IPOs, for example. So as a private equity firm, we also do strategic buy. So a strategic party could help us monetize a deal, or we could do a secondary deal, or there could be a sponsor-to-sponsor deal. So where I agree with Brad is that certainly IPO volume is down. It picked up last year, but our activity levels have actually been able to be sustained because of those other opportunities to monetize our investments. Now, when you think about where we're sourcing investments or what opportunities we're seeing or investment themes, they're plentiful. Based on what I described in my opening remarks, what we're witnessing, we're essentially going to where the puck is moving, right? So there's a tremendous amount of transformation, a tremendous amount of uncertainty, but there's some things you can be certain about. One, the past 10 years have been a story about U.S. exceptionalism, where the U.S. dominated in many different areas, and it was essentially a unipolar world. We're moving into more of a world that's multipolar, where relative value is actually improving in Europe and Asia versus in the US. And so that's a big area of opportunity for us, where we're leaning into investments in Europe and Asia. In Asia, it's about intra-Asia trade. In Europe, infrastructure, energy transition, data centers are massive ways where we're invested. The other big theme for us is worker retraining. So with all of the technological disruption, AI included, that will only accelerate going forward, there's going to be a tremendous need for workers to shift industries, right? Because if you have a team today that, for a research team, has an MD, has a few directors and a few 5 or 10 analysts, going forward, that model might not be necessary, right? So what are those 5 extra analysts going to do? We, in the US, over the past, for many decades, we've underinvested in worker retraining versus our counterparts abroad. And so that's an area where private capital, I think, will continue to step in. So we are leading in there. The other one I'll just throw out is security. So in what I mentioned, there's a big change in how nation states are relating to each other. And there's much more of a focus on the protection of strategic assets. So that could be data. That could be pharmaceuticals, that could be energy, you name it. And so protecting those assets, both from a national perspective as well as for companies and individuals, is also an area that we're leaning into. And those are just examples of some of our big themes. But all that to say is there is a lot of uncertainty. Consumers are spending less. corporations are spending or investing less as well, but there is still investment opportunity. And a lot of that going forward is going to have to rely on private capital because administrations and governments are hung by debt, right? And so that comes back to the opportunity around private markets, which we haven't considered.
Excellent. Thank you for that. Next question is, Dominic, for you. There was a lot of volatility in the markets this past spring. You touched on that. During that time, what advice were you giving to your clients as things were changing so fast?
Yeah, so I'd say first and foremost, we don't position portfolios for the short term. So we had a lot of conversations about, the construction of a specific client's portfolio and how it was built for longer term needs, setting aside shorter term assets for any kind of short term liabilities, really kind of cutting through what the headlines were versus any fundamental changes helped a lot. We really didn't have any clients sell out, which, as we saw, we had a 40% total swing within 30 days. So that kind of taught us that, a knee-jerk reaction really does not lead to a prudent investment decision. And we also have a fair amount of clients that do invest in private and alternative assets, which, to Paula's point, helped with some of the resiliency of how you feel when times like that happen. If anything, I think we had more clients being opportunistic about the moment, whether that was in the public markets or opportunities to lean more into alternatives, given what's going on in certain asset classes that won't necessarily benefit from tariffs, but can deviate from the issues that they were creating. So I think overall, our clients had a really good experience. We did get ahead of a few different areas, just the way we position, being a little more defensive after a really solid 2-year U.S. bull market run in the public markets. So we did kind of position ourselves a little bit with some exposure to, asset classes like utilities and like cybersecurity that I had mentioned that aren't as impacted by these decisions. But still, I think the private and alternatives were a much more resilient area, given, public stocks tend to all trade together to some capacity, even if they're not as correlated from a fundamental basis.
Yeah, thank you. Brad, next one's for you. Can you commented on this a little bit, but can you comment on the challenges encountered in quantifying some of the tariff-related risks or costs during due diligence, and what does that look like?
Yeah, no, that's a fun one. Quantifying tariff-related risks during diligence is tricky. Challenges with middle market deals and M&A, to me, always starts fundamentally with data. Garbage in, garbage out. I think that applies to any scalable business, but it can be more of a challenge with less sophisticated businesses in the middle market. So first, data gaps are a headache. Companies might not break out tariff-specific expenses in their financials. So you're stuck estimating cost impacts from cost of goods sold or supplier contracts, which can be a little murky sometimes. Second, tariff policies, as we've all seen, have shifted fast. They might have changed while we've been on this call even, I'm not sure. But you know, they're not set in stone. So forecasting relies on scenarios that could change mid-deal. So a lot of our pro forma numbers when we started a deal might be different at the end, 2, 3, 4 weeks into it. And some of these processes are taking even longer, 6, 7, 8 weeks for some of our buyer diligence now. So third, it's hard to pin down downstream effects like, can you pass on and will your customers eat a 10% price hike or will demand tank? Those are very tough things to calculate and predict. You need robust market analysis, but that's also sometimes speculative. And then supply chain complexity adds another layer. Tracing tariff exposure across global vendors is a nightmare without good procurement data. It all comes back to data. So, when we're doing some of this analysis, sometimes we're doing kind of a sensitivity analysis that put some high and low ends on tariff hikes and impact of that. And we're kind of doing sensitivity analysis. Putting a hard and fast number to something is not advisable right now. You kind of need to look at a broader range of where things could fall out, because it could change tomorrow, right? So that's a little bit what we're seeing. And then obviously, speaking with your peers out in the industry, what are they seeing? How are they doing it? Cross-checking kind of how you're underwriting your financial models with them is always, I think, a best practice right now. So.
Yeah, I imagine a lot of real-time updates with all the changes that are going on in those models.
Absolutely. So. Yeah.
Dominic, back to you. Are there approaches beyond traditional stock and bond diversification that you can take to lower volatility in a client's portfolio?
Yeah, I think both Paul and I kind of touched on this, and it's obviously in the realm of what KKR does, but using private and alternative assets has never been easier, which doesn't always mean it's right, but it's never been more accessible. So working with a team to help you do that is obviously imperative, is what I'll lead out with. But through kind of a democratization and technology being at the forefront of how we get access to these funds, we're able to access either alternative asset classes that resemble public stocks and bonds, or alternatives that are completely different and outside of what you can really get exposure to in public stocks and bonds. Things like actual infrastructure assets, which there's not really a public comparable, in my opinion. Things like direct real estate, which is probably the most familiar, but when it is held directly, the performance and operation of it is much different than holding a public REIT, given, again, the correlation of how assets trade in the public markets. So building a portfolio with exposure to those, you're able to not only, I think the number one thing most people consider is excess returns for those asset classes, but you're also able to lower volatility with some of those on their own, and then some with the how they price, how the assets actually operate, and the type of assets. So there's a lot of ways to do that when you encompass privates and alternatives. I think that the key that we work with on clients, given the illiquidity of those assets, is how much they should have exposure to, how much of each asset class outside of public markets they should have exposure to. So that way they're not becoming so illiquid that it becomes an issue to another extent of not being able to access those assets when they need them. So I know it's been a popular thing in markets in general. I think it's imperative, though, working with a team to help structure that for yourself, and then whoever you're working with, vetting and finding the appropriate general partners to work with. Because in private markets, the variance of returns is light years wider than what you see in public markets. In public markets, there's a lot of index-like exposure and therefore index-like performance. In private markets, there's just a wide disparity between the top performer and the bottom performer. So choosing the right asset classes, right assets, and the right general partners to invest in is huge.
Just to put some numbers on that, so private equity manager dispersion is something like 900 basis points, right? So picking your manager is pretty critical. And also, even within asset classes, the strategies that a manager might employ could be very different. So really doing your due diligence so that you know what you're invested behind and with whom you're invested is critical. And maybe I'd add one more point, if I may, Torre, then. I think Dominic's points I certainly agree with. The crux of it is diversification, right? That's underlying everything we're saying, especially if what we're saying is in this environment, a 60-40 portfolio isn't inherently as diversified as it used to be. You need to source that diversification elsewhere. So asset class, but being clear that that asset class has orthogonal performance or low correlation is key, right? But then also thinking about geography and sector. Because the U.S. exceptionalism story has done so well for the past 5 years, there are a lot of portfolios that have home bias. Same if you're within Europe or within Asia. Trying to, if you're in the U.S., tilt the portfolio a little bit to take advantage of what we see as upside in Europe and Asia will also help you mitigate against some of that volatility.
Thank you. Question here from the audience. I'll just throw it up to whoever wants to grab it. So this is probably impossible to answer, but do you think China is going to be eliminated as a supplier to smaller U.S. companies? And maybe I'll just leave it there. Dominic, Paula, any comments on that? Or I know that's a hard one.
I think it would be difficult to eliminate China as a supplier, sort of period, right? That China has been the low-cost producer for a long time. There are many embedded supply chains that involve China. So even if there were an edict tomorrow, implementation would take a very long time, to be near impossible. That said, we have seen the broader ASEAN area take the place of some of the transfer of goods. So that is occurring, but I don't see a complete elimination of China. One, because, China has honed processes and systems and relationships over not just, a couple of years, but decades. And two, it would be very costly. So for a small company in particular to replace China, the cost of that might eat away at whatever margin they have, and so would make it not an economic decision.
Yeah, I would agree. I think there's a lot of headline discussion around that, and I do think it's part of the intent of the administration's efforts with the tariffs to decouple kind of everyone else from China as well. But the ability to do that is just so arduous. I mean, I'll go the other direction and say that, Apple announcing that the iPhone is going to be somewhat made in India, and in reality, it's really not. Pieces are going to be flown from China to India and then assembled there because it is so costly to fully stand up and do that. So even one of the largest corporations out there can't really feasibly decouple from China overnight, let alone throughout the next year or probably a handful of years. So I fully agree with Paula there.
Brad, back to you. On the deals that you're seeing, and how do you work with deal teams to incorporate some of these tariff impacts in the financial models, in the integration, and in their integration plans?
Yeah, good question. And a lot of it starts with a really collaborative dialogue with our clients. They are embedded with these deals for a very long, extended period of time. We're kind of brought in kind of mid-deal to help shepherd some expertise in certain areas. So it starts with a lot of open dialogue. A lot of our clients are getting market studies done and really working to go deep with vendor diligence and understanding the role that these vendors play in the operations of these companies that they're targeting. So it's really leveraging maybe some other third-party, again, vendor diligence that they've obtained and working that into some of our pro forma analysis. But it's similar to what I said earlier about kind of putting a sensitivity analysis together, kind of a stress test, 5, 10, 20% tariff hikes, how that kind of impacts EBITDA, especially for manufacturers that have Chinese or Mexican inputs. Again, I touched on this a little bit earlier, but I think the working capital assumptions, factoring in higher inventory costs, longer lead times due to supply chain shifts is stuff that we're having to be thoughtful about. We're definitely asking the questions of how are they thinking about it. A lot of this then leads to kind of post-close and integration plans. The smart teams are prioritizing supply chain audits kind of post-deal. They might plan to diversify suppliers away from high tariff regions, but I think like the two speakers, much smarter on the macro global events than myself, it's not easy. And there's a dependence on it that you just can't shake immediately. But, moving sources maybe from China to Vietnam or India, it takes time. And it's not going to be, the first month post-close. No matter how, even if you've been doing some of this work even prior to close, it does not happen overnight. there will be a lot of, and budget needs to be put in for one-time costs like supplier onboarding, logistic tweaks, stuff like that. So those are things that our clients are having to think about. And also putting these models together for integration plans, and what a lot of our clients are seeing with middle market is that they haven't had a price increase in forever for whatever reason. The company's been making money, everyone's happy, but that doesn't maybe not work for a more savvy investor or buyer of a business. So they're building contingencies for customer pushback on price increases. They're all going to ask for them to at least get to market or to get to a margin that they can underwrite for profitability. So some of them are offering temporary discounts to retain volume, and you know, to varying degrees of success. But you got to ask for it and see if your customers are willing to do that. All that being said, that makes for a very malleable financial model, one with a lot of moving parts and inputs that could change tomorrow, right? So again, it's become more of a live breathing model than maybe a static one that we have traditionally had in the past when we're helping our clients put together forecasts and projections. So
good, thanks, Brad. Okay, I think we probably got time for one more. Follow up to the China question. We got an audience question here. Does migration from China to other Southeast Asian countries as a supplier create opportunities for investment in those countries? Thinking Thailand, Vietnam, Cambodia, India. Paula, maybe I'll start with you on that. You kind of touched on that earlier. But
no, I did. We do see it as a massive investment opportunity, amplified actually by what's happened recently, but we've long been leaning into countries like India, for example. So India, Vietnam, where our thesis overall is invest in domestic consumption stories as well as in intra-Asia trade. So the intra-Asia trade benefits all the countries you just mentioned. On top of that, given the corporate reforms we've seen in India, the fact that there is a large working age population who have increasing wages, and increasing working age population, that's an opportunity for investment for us. So we're leaning in heavily there. So I agree with the premise of the question.
And I think that just about takes us to time. Really appreciate the discussion today. Great job to all the presenters. Thanks to the audience for some great questions being submitted. And with Kiva, or I'll turn it back to Kiva to close us out.
Thank you, Torre. And thank you, Paula, Bradley, and Dominic for a great presentation today. If we didn't have time to answer your questions, we will do our best to follow up with you after the webcast. But please feel free to reach out to any of our presenters if you have additional questions. Finally, here's a link to a survey for today's presentation. Your feedback is always appreciated. Again, thank you for joining us, and take care, everyone.